Let's discuss the role of the buy side and sell side in financial markets. In the last video, we discussed the assets and liabilities of governments, individuals, and corporations. In this video, we're going to discuss the financial intermediaries between the asset side and liability side of the balance sheet. Let's start with individuals. How do we go from houses, cars, and shoes to mortgages, car loans, and credit cards? We generally go through a bank. The bank makes us the loans for these products. Now, for governments and their infrastructure, they go through a Wall Street broker-dealer or a securities unit of the investment bank to issue the bonds. Corporations have a choice to finance their working capital and capex. They can go through banks to get a bank loan, or they can go through broker-dealers on Wall Street to issue bonds or equity. So let's talk about the difference between a bank and a broker-dealer. Many banks have an affiliated broker-dealer. The broker-dealer is typically the securities arm. So notice how Bank of America and KeyBank differentiate their bank and securities arm. One spells bank with a K, one spells bank with a C. It's not a typo. It's a regulatory requirement to avoid confusing the general public when you're dealing with the bank that you make deposits at versus the securities broker-dealer that is the trading arm. On Wall Street, depending on what you trade, you may be trading out of different legal entities. You may be trading out of the bank entity if you're trading derivatives such as foreign exchange or interest rate swaps. And you may be trading out of the broker-dealer or the securities unit if you're trading bonds and stocks. So all these financial assets that we talked about for individuals, corporations, and governments, where do they go? They go to a group that we call buy-side investors. This includes the banks for deposit accounts, the brokerage accounts, mutual funds, insurance plans, pension funds, and hedge funds. So all the financial assets of the individuals, corporates, and governments, all these institutions funnel through these buy-side investors. It's worth highlighting that these investors themselves aren't naturally flush with cash. They need to get all these end users to give them cash for them to invest. So the bank deposits go to banks, and the rest of the buy-side investors work with broker-dealers to find investments for their funds or investment accounts. We call the broker-dealers the sell side, as they sell investment products to the buy-side investors. The banks use the cash to make loans, whether it's a mortgage loan, auto loan, or a credit card loan to an individual, as well as corporate loans to a company. The broker-dealer sells bonds and stocks, and we call these stocks equity. Equities of companies, as well as government bonds, to these buy-side investors. Note that the flow of funds go from the asset side of the individuals, corporates, and governments through the buy-side investors, then to the sell-side investment banks, to the underlying loans, bonds, and equities, which are obligations of the individuals, corporates, and governments. Both the buy side and the sell side are middlemen in this process. Now, there are a lot more investors on the buy side other than banks. Could any of these investors buy the loans that were made by these banks to even out the supply and demand dynamics? The answer is yes. So this is called securitization. You have an SPV that buys up these loans and issues the bonds to finance them. This allows the capital to flow to the other side, to the buy-side investors. In the reverse case, where the bank has more cash, the bank can easily directly buy the bonds through a broker-dealer. So putting this all together again, governments, individuals, and companies are the driver of the supply and demand of bonds, stocks, and investments. Their assets go to the buy-side investors who invest in the market. Their liabilities form the basis of the capital markets of investable products. So buy-side investors buy from sell-side broker-dealers, which are part of an investment bank. On Wall Street, we have specific names for each product. We'll cover each product in a bit more detail later on in this course. So starting with governments, for the currency, the cash that they can print, exchanging one currency of one government for a currency of another government is called foreign exchange. The bonds that the governments issue are called government bonds. The mortgage loans, when securitized into bonds, form mortgage-backed securities. Auto loans and credit cards form asset-backed securities. Corporate loans, when securitized into a bond, form a collateralized loan obligation or a CLO. Companies can issue bonds directly, and that forms corporate bonds, and companies can also issue shares or equities, and that forms the equity markets. We just finished discussing the role of the buy side and sell side in financial markets. In the next video, we'll take a look at buy side investors in more detail. We'll see you in the next video.